From the morning reading, spiders, diamonds, and IWM make new all-time closing highs as the financial sector leads. Breadth weakened compared to the prior session slightly as advancers led 2161 to 868 on the New York Stock Exchange and led 1901 to 884 on the Nasdaq. Oil futures were down 25 cents to close at $50.70. On the S&P 500 snapshot, another advance and just shy of a record close. Equity indices around the globe rallied, and the Dow ended the session at another record close. The S&P 500 posted a modest gain of 0.34%, just a tad off its intraday high and a mere 0.05% from its latest record close on November 25th. But from an international perspective, the big winner today was Italy's market, up 4.15%. Of course, the MIB is still down 17.1% year to date. The yield on the 10-year note closed at 2.39%, unchanged from its previous close. Bonds can't catch a break. They've been selling off with such persistence that it's nearing historic proportions. Using the yield on 10-year Treasury notes, a look at the move over 3 time frames shows one of the largest moves since 1962. We're basically seeing a mirror image of the market from early July. Part of the reason is good economic data. Across developed and emerging markets, economic reports have been consistently beating expectations, helping to drive yields higher. This is only the second time since 2014 when every major economic surprise index from Citigroup was showing a positive number. Financials have certainly benefited. The average of more than 25% of financial stocks have reached a 52-week high during the past month, the second most since 1998 and one of the highest since 1990. By the time these many financial stocks have reached a 52-week high, for this long a time period, the sector has been primed to settle back over the next several weeks at least. The spread between optimism and pessimistic indicators is getting stretched, like really stretched. Nearly 45% of the core indicators are showing extreme optimism, while 0% are showing pessimism. That has been matched only by late August 2000, mid-December 2010, late February, early March, and early April 2015, and mid to late August 2016. Only December 2010 showed gains over the medium term, and those gains were then wiped out during the subsequent protracted correction. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:06 a.m. Mountain Time, and I am recording this in preparation for the market day of December the 7th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. At the time of this cut, the 4 U.S. broad-based indices were all rotating around scratch. Crude oil was down about 0.6%, euro is up just above scratch, bonds were up about 0.5%, and gold was up almost 0.5%. And overseas action, looks like everybody was open that we followed. China was up about 0.75%, Hong Kong up a little over 0.5%, Japan about 0.75%, Germany about 1.5%, and United Kingdom also up about 1.5%. And macroeconomic reports for the United States of note for today, we have crude oil inventories weekly report. Looking ahead to tomorrow, we have the weekly unemployment claims and natural gas storage. And that seems to be about it. And looking to volatility conditions, short-term VIX down to a 10.84. Skew continues to climb slowly but surely. We're now up over a 130. IV percentiles all exceptionally low, in the lower 20 percentile range. S&P to 13, the Russell 14, the Nasdaq a 17, and the Dow a 14. We did have a standard deviation size move put in yesterday by the Russell, and that looks to be about it. Let's go ahead and bounce over to the charts. And our S&P, you see yesterday, followed through on the bull flag breakout from the prior session, confirmed that action, and then closed right at the prior high close. That was at 2211.75, and yesterday's close was at 2211.50. One tick off on the futures market from the previous all-time high close. Now we had an intraday high that poked up to 2213.75 about 3 days after that closing high, but certainly very bullish short-term action. We had, of course, the breakout, a bull flag consolidation. That bull flag fired after doing a false breakout down below the support area. Totally reversed. Big, strong candle confirmed that bull flag move, took us up to what for most people had been the first target on their bull flag, and a bit of a consolidation sitting there at this point. So right now we have a bit of a overhead resistance pattern at the former highs, and we're just kind of chattering through that area. I suspect that that is not a significant area of resistance, and that could easily fall with any kind of momentum move at all across the markets. And the Dow, of course, has not even set up for a bull flag. It has just continued to move higher, and nothing in the short-term pattern there to show anything that's going to stop it other than just simple exhaustion. Nasdaq, of course, has been much more volatile of lately and has been, been trading inside this range. Right now, we're as neutral as can be. We're smack inside the cloud and about halfway between the range top and the range bottom. Let's take a look at the Russell. Russell, of course, also had a bit of a bull flag pattern, and after that kind of historic 15-day consecutive closing session of green candles, set up for a bull flag, came back within the channel, but then fired off the bull flag, confirmed on that action, and is now legged up back towards the all-time highs, set a new closing high and a new intraday high with yesterday's session, and nothing has been given up on that thus far today. So the Russell continues to be exceptionally strong. And in other markets, crude oil, of course, is run up against this area of resistance. And while it has had a false breakout above that, has blacked out back down since then. And so this, in this case, this area of overhead resistance seems to be significant, and the market's really struggling to be able to get through that. And gold, of course, has been in a strong bear trend, and nothing seems to be stopping that at this point. There's no signs of reversal or anything like that that look to be of any significance. And bonds also seems to be in a strong bear trend. One of your morning authors mentioned about that, and again, nothing that looks like a big time reversal pattern there as of yet. Dollar has pulled back some and is at this point consolidating. Expectation though would be for the next leg of the dollar to go higher. And then let's take a quick look at volatility. Volatility is just getting down about as low as it can get in historic terms. We've been down as low this morning as 11.41. You have your 52-week low at 11.02. So very, very, very low levels of volatility, which would seem to tell you that while we might have a rise in volatility at some point, there certainly isn't being priced any significantly large moves into the market at this time. Okay, let's go over to the daily report. And we continue to have kind of mixed signals over here. We want to be able to sit here and bestow that, the opinion says that the market is a healthy bull market in terms of a series of higher highs and higher lows and so forth. But we continue to get this just enough chop and sideways action to prevent this from really lining up. We are in market intermediate term phase opinion, market phase 4, price patterns near resistance and extension. Right now, it would seem that our bull flag pattern did follow through, so we'll continue to watch that, see if this goes back to market phase 3. In terms of the 3 market timing signals, the first one from IBD is uptrend under pressure, and that, is the first level of warning sign. GMI index is at a 5 out of 6. That one is giving a full out buy signal, and that one's been in place since 11:10. Stock charts decision point scoreboard also giving some mixed signals, and the most recent change, of course, was a couple sessions ago, and that was a bearish signal in the short term for this NASDAQ. So we're watching to wait and see if this bull flag pattern that's formed in some of the markets, like the S&P and the Dow, I guess we had the bull flag on the S&P. The Dow just flat out has just continued to be bullish. But we'll start to see if we can get some of these NASDAQ patterns and also into the intermediate term to start to turn green on the remaining bearish signals and start to give us an improving score. Overall, though, the consensus of these signals is bullish, albeit perhaps weak bull at this point. Now, the 2 position sizing opinions, one's at 50%, the other's at 75%, so kind of keep that in mind. In terms of intermediate term market posture, we still have a severely strong bull, and that's further supported by a strong bullish sentiment line. You do have the NASDAQ in weak bear, so that is the one index that is kind of dragging overall performance down. Hedge warning status remains 0+, normal with some elevated conditions. Strategy opinions, no new changes from this on this yesterday. We've actually been a couple weeks now with basically the same set of opinions, and that is positive for the ability to initiate new positions for novice traders, while at the same time maintaining some level of defensiveness given these patterns up against resistance areas. In terms of specific warning areas, we've got some minor. The volatility ratio warning is set up for a new potential firing, but has not yet fired. The VIX futures actually dropped below 12, which is actually a bit of a warning. At some point, you expect volatility to expand, and so kind of like this one, we have a setup for expanding volatility, looking at this in a couple different ways, but they have not yet fired. So these are kind of low-grade warnings. More serious is the distribution day count on the NASDAQ continues to be high, and actually the skew is now up over 130, so that warning would now give us about a 10% probability of a 2 standard deviation move in the next 30 days. Trend-based areas, though, there's no warnings here. These are all fine. Intermarket risk aversion indicators, though, are giving us some warnings. While all 5 indicators had showed signs of rolling over, 3 have actually just barely rolled over. The other 2 are close. So definitely showing some signs of weakness there. From a sentiment standpoint, stocks both short and intermediate term are starting to get a bit extreme, and you see on the fear and greed index, you now are up in the extreme greed area, coming in at a 77. Now, the sentiment index, just because they're extreme, doesn't mean that we expect an immediate reversal. It just means that we're now watching for signs of a reversal. In terms of sector specific, pretty strong day yesterday. Telecom, financials, consumer discretionary, real estate, consumer staples are your leaders. So it's kind of a mixed bag of risk on and risk off sectors. The two that were down yesterday, energy and utilities, were down really quite modestly, and certainly about half the companies were, almost half the companies in those two sectors were still positive. In terms of market postures by time frame for the sectors, you see we continue to see this rotation impact with consumer staples, healthcare, utilities, and technology showing pretty significant weakness compared to some of the other sectors, such as financials, energy, industrials, and materials all are up. And I think that's probably enough for today. Let's go ahead and wrap this thing up. And if you're not subscribed to us on the YouTube channel, let me just mention a couple things here. If you go to this hyperlink right here, that'll take you to our YouTube channel. And when we say subscribe, it's free. It's just basically when you subscribe to the YouTube channel, it gives you an alert when new content is posted. We generally try to get this out by about 6:30 Mountain Time, or an hour before the market opens. But obviously it's plus or minus depending on how our morning is going in terms of how much material we have and all those kinds of things. Other things to be aware of with the YouTube video is be sure to access these gear settings. You'll see the little gear button. Make sure you're watching it in high def resolution. Also, you can go to full screen if you'd like, but some of the charts and so forth certainly will play back and be much clearer for your visibility if you're playing back in high def. Now, once content has been published, it will be available in something less than high def often, but then after a couple minutes, you can go ahead and toggle that to high def. Now, frankly, usually the first couple minutes, I'm sharing some interesting findings from various authors that I follow in our morning reading, so you could pretty much just listen, and then by the time I start actually getting to the charts, flop that over to high def. Also, the other thing that you can do is speed the process up. You can probably understand what I'm saying a lot faster than I can speak it, and you could probably play the video back at 1.5x and be able to follow along. And then of course you can always slow it down if you hit a section that you really want to pay a lot of attention to. These other slides we'll just go through. If you see something of interest, just hit the pause button and you can go to the hyperlink and get additional information. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back here next for tomorrow's session of the Falcon Global Market Preview. In the meantime, manage your risk profile and seek each and every day to go out there and learn something about your trading and investing craft.